Hi everyone! Last week the stock market closed mixed. The Dow Jones lost 0.1%, while other benchmark indices, the S&P 500 and the NASDAQ, scored better results. Investors are in no hurry to make forecasts on the Fed's monetary policy based on the published economic reports. For instance, the non-farm payrolls report could have significantly affected market sentiment, yet it did not take place. Perhaps the market reaction was muted due to the holiday season. The remaining traders seem to believe in the resilience of the US economy. They are confident that it will be able to improve, despite aggressive rate hikes and record inflation. Besides, many speculators tend to think that inflation has already peaked. Fed policymakers advise not to jump to conclusions, as traders can be deceived by fake signs of slowing inflation. It has already happened many times. This week, market participants are awaiting inflation data. If the figure declines more than expected, the chances of a further aggressive rate hike will decrease. As a result, risk appetite will return. Apparently, talks about rate hikes are going to significantly impact market movements this week. Watch our video review till the end and leave your comments down below. Let's start. Last week was quite eventful. Apart from anticipation of crucial economic reports, traders also assessed geopolitical risks. Tensions escalated ahead of Nancy Pelosi's trip to Taiwan. The markets could have got volatile at least for a short period. Nevertheless, geopolitical tensions over Taiwan eased quickly, and this event was of little concern to traders. They practically did not pay attention to China's military exercises near Taiwan and Washington's attempt to somehow prevent this, or at least to protest. However, it does not mean that the risks have gone and there is nothing to worry about. As relations between China and the US remain strained, it is better not to overlook these risks. Of course, they will hardly affect market sentiment, yet they may somewhat limit optimism in the near future. The non-farm payrolls report released at the end of the week also did not stir up Wall Street. The figure significantly surpassed forecasts. The economy added 500,000 new jobs versus the consensus reading of 250,000. So this report definitely gave food for thought and opportunities to gain a profit. The labor market reports help analysts make long-term forecasts on the Fed's monetary policy. Companies continue to raise wages. If wages keep growing, firms are likely to add output costs to prices. It will stimulate purchasing power and demand. However, it will also boost inflationary pressures. This is why the Fed is highly likely to undertake more rate hikes. After this report, the probability of a rate hike by 75 basis points increased sharply to 66% from 29%. Following the release of NFP data on Friday, trading on Wall Street was mixed. The Dow Jones rose by more than 70 basis points, while the S&P 500 and the NASDAQ fell by 0.2% and 0.5% respectively. The weekly results were the exact opposite. The Dow incurred small losses, having remained almost at the opening levels. Judging by the movements at the start of the week, the uptrend may unfold. The Dow Jones kicked off the week with an increase, as well as other stock indices. Investors were revising the prospects for monetary policy tightening. On the one hand, the central bank is highly likely to stick to aggressive tightening. Fed officials have stated many times that the main priority is to take inflation under control. On the other hand, the regulator will hardly raise rates until inflation reaches the 2% target. Investors expect inflation to hit this target in the next 6 to 12 months. If so, the Fed should hike the interest rate until the end of the next year. However, it may negatively impact GDP growth. Traders believe that the Fed will stop tightening monetary policy as soon as there are signals of a slowdown in inflation. Thus, there will be several more rate increases. U.S. consumer inflation expectations for the year ahead dropped to 6.2% from 6.8% in July. This is the lowest figure in 5 months. Inflation expectations for 3 years ahead decreased to 3.2% from 3.6%. After strong jobs data, investors are waiting for the inflation report with bated breath. In July, the CPI index is projected to decline to 8.7% from 9.1%. If this scenario comes true, it will indicate that inflation has peaked. The regulator is likely to hike rates according to the initial plan, as inflation should continue to drop. Last week, policymakers backed a 50 basis point rate increase. Some commodity prices have already started to tumble. Currently, the main problem is the housing market, where there is almost no improvement. The CPI index is a crucial indicator. To this end, its release will surely influence market movements. The S&P 500 index ended last week with gains, albeit insignificant. This is why it is too early to talk about a trend reversal. It is trading in the same range. However, the index was able to break through the strong resistance level of 4,139 and came close to the long resistance level of 4,180. This level separates the bullish trend from the bearish one. Its breakout may facilitate the long-term bullish trend of the S&P 500. At the moment, the index is moving in the resistance zone of 4,090–4,160. If market sentiment does not change this week, there is a high likelihood of an upward trend reversal. The index is expected to hover in the range of 4,300–4,360. Yet a bearish scenario cannot also be ruled out. Judging by technical indicators, the S&P 500 is now balancing between the bear and bull market. If the bears assert strength, they could push the index to 3,750. The heavy tech NASDAQ 100 logged the largest increase last week compared to other indices. Investors are now concerned about how high the index may rise. They're asking questions like, what is really going on? Is this a trap of the start of the bull market? If in mid-June traders were mainly focused on the information of the bottom on the stock market, now they prefer to be sitting on the sidelines. There is a high possibility of a downward movement as investors expect further monetary tightening. Some analysts interpreted Jerome Powell's comments at the July meetings as hints of a softer stance, which fueled the rally. A V-shaped recovery in stocks, to which investors are used to, is unlikely to occur this time. Apart from macro stats that may affect the Fed monetary policy decisions, stocks also react to the earnings reports. Yet the earnings season will end soon. Overall, the quarterly results were quite positive. For instance, 56% of companies included in the S&P 500 index revealed their earnings results, with 73% topping analyst forecasts for EPS and 66% for revenue. Berkshire Hathaway and Walt Disney are going to unveil their quarterly reports this week. That is all for now. Subscribe to our channel and keep close tabs on market developments. See you.